We've been looking at particular statistics like the PE ratio as a method of tracking the strength and vitality of a market. But did it ever occur to you that the numbers that this is made up of are fraudulent? What does that tell you about the entire stock market itself? Let's investigate further into what's really going on. You came here for the truth, so let me unveil that for you. Today we're going to look at the Buffett indicator as well as many others. Let's begin. This is the Buffett indicator. That is the Wilshire 5000 market cap versus the GDP. What is the Wilshire 5000? For those who don't know, Wilshire 5000 is all of the stocks in the US put together into one index. That gives you a much more broad spectrum, gives you a better understanding of what's happening, instead of just looking at the Dow Jones, for example, which is only a handful of stocks. This gives you a much better way to look at it. Now, we are currently at a level of 1.296. All right, that has been exceeded already of the financial crisis and everything before it. The only time not exceeded yet is the dot-com boom and bust. And should we be able to go just a little higher, we would definitely be exceeding where we were, making this the biggest bubble in history, according to the Buffett indicator. Why has this gone so high? Well, the fact is that the economy has not risen at the level that the stocks have. And again, covered it many times before, you are looking at just a handful of stocks pushing this up in this territory. You need to understand where this is heading, and that's done very simply by looking at as many indicators as you possibly can, piecing them all together, using the widest spectrum, and really looking at it for the truthful methods. And I'll get into that in a second here. So, a buoyant and complacent stock market is worrying Richard H. Thaler, the University of Chicago professor, who this week won the Nobel Prize in economics. This is what he said. We seem to be living in the riskiest moment of our lives, and yet the stock market seems to be napping. And you're seeing that with the volatility index. I admit to not understanding it. This guy wins a Nobel Prize in economics, and he said, I don't understand the stock market. And a lot of people out there who they've been looking at the stock market for maybe 6 months and they apparently are experts. This is very funny because I see this and the guy is considered to be, a very intelligent person in the field of economics, and he's saying, I don't understand it. Why? Because nothing makes sense. Everything's out of whack. Central banks have permanently ruined the system. It's destroyed. It's not coming back. There will be no salvation for the system. And the more intervention that is done, the worse it gets. Should that surprise you? Well, not really. Looking at this here, you can see that he's not the only individual that's concerned. Look at this. Adjusted Bogle valuation measure. Okay, now this gentleman has decided to recalculate the PE ratios. When you take things for what they are, you end up getting screwed a lot of times. What he has done is used generally accepted accounting principles, or GAAP. You would know that because that's what you and I have to abide by. But the governments don't, and neither do the big corporations. So what do? They take everything and they hide it off their books. And they're able to do this legally. They're able to take everything, put it off to the side, and they do so, for example, with their derivatives. They're technically liabilities, but they don't have to put that on their books, or else every single bank would be insolvent. Governments do the exact same thing. They have intragovernmental debt. They have off-balance sheet numbers like Social Security, Medicare, Medicaid, off-balance sheet. Keep them off the books and you don't have a problem, okay? So then we look at this here. You're looking at his recalculated valuation measure, and you see that we are now at 26.81. Historically, we go back to, I believe the number is 1871, where Shiller calculates the PE ratios. You'll see that at 16 or 17 historically. Okay, from now until all the way back then, 16 or 17. We are now at 26.81. Does that mean that it's overvalued? The answer is, based on this indicator, yes. We've exceeded that before. It doesn't matter. We're talking about averages here. Okay, the average is exceeding. When you look at some of these particular stocks, which are in, around 200, many of them, 100 even, you'll see these going to levels not seen since the dot-com boom and bust. That doesn't worry anybody, however, because they have amnesia. Going back into the financial crisis, prior to that, you look at the dot-com boom, and you'll see that just after it, they would say things like, I can't believe they didn't see it. It was such a bubble. What craziness. They didn't even have anything to these businesses. All they were was an idea, and everything got blown way out of proportion. Investors just pumped all their money. People who had no sophistication started thinking that they were traders all of a sudden and started losing a lot of money very rapidly, didn't know when to sell, lost most of their money, lost their houses, lost everything that they had, all because they didn't realize what was happening, and they got sucked into the trap. Tobin's Q ratio and Shiller's PE 10 and versus the 10-year forward returns. All I want to note is one thing, and that is currently at levels seen at every previous bull market peak. Okay? Right here, back all the way, looking all the way literally to 1900, and seeing that, yes, we are exceeding this every single time using these two indicators, and nobody wants to pay attention to it. Okay? It's just more to pile on. Mario Draghi says ECB's negative, this is not a joke, by the way, okay? This is right out of Fox. Draghi says that the ECB's negative rates have been a success. And I'm serious. I'm holding in my laughter, but this is real. This is what he said. He said that the central bank's negative interest rate policies haven't hurt bank profitability as critics suggested they would. He also reiterated that the ECB's guidance that asset purchases would continue until officials see sustained improvement in the outlook for inflation, and that interest rates would remain at current levels well past the time it stops buying assets. Interest rates will remain low in the Eurozone. They've gone into the negative, meaning money is so worthless right now. It is so worthless. They want to scare people out of hoarding cash. They want to scare people out of all of this and go into higher risk investments. That's what they want, and they're getting that for some people. Some people are willing to lose the money. There are investment companies that are buying trillions and trillions worth of garbage that's giving a negative yield on it. I mean, I can't even believe we're living in this time. This is talking about the hurricanes that have taken place recently and investors which have come around and decided to buy up the properties, okay? The cycle begins with the small-time investors such as Schild, who bought more than 30 waterlogged houses for an average of $175,000 apiece. Then Wall Street swoops in. This former chief executive here, seeing it as an opportunity, is pitching private equity firms and pension funds on the potential profit of buying flooded homes, repairing them, renting them back to homeowners. So there's a couple points I want to make. I'm not going to give my opinion necessarily, but essentially what's happening is some people will call this vultures, that they will come in, they're going to fix it up, they're going to then rent it back to the people, chances are, that were living there in the first place. So there was a homeowner. He was in a more, let's say, safer area, didn't need to get the flood insurance, and then he has a flood, it completely destroys his house. The federal assistance, what I was reading in here, would give some of these people as little as $20,000, not enough to repair their home. So they're forced, in a way, to sell. They got to live somewhere, can't live there. They don't have any real money. They still owe money on their mortgage. What are they going to do? Well, they're going to sell it to an investor for basically nothing. And a lot of people are really getting hurt by this. I mean, it's a natural disaster. That's just the way it is. It happens. What I find interesting is that these banks, they'll buy it up, they'll sell it to pension funds and everything else. It just gets packaged into all this garbage that's out there. All of these collateralized debt obligations. You're seeing mortgage-backed securities and everything else, and it just gets sold over and over again, repackaged, sold, repackaged, sold. And it started off as some people just living in their house, and they're able to turn anything into a so-called investment. I think it's just strange. This is Benjamin Shalom Bernanke. That is his real middle name, by the way. Ben Bernanke, Helicopter Ben. All right, so he wrote this in Brookings. This is his article. And he's talking about price level targeting. Instead of going through inflation targeting, that we should go to price level targeting. An alternative monetary framework discussed favorably by the President Williams and by a number of others is price level targeting. A price level targeting central bank tries to keep the level of prices on a steady growth path, rising by, say, 2% per year. In other words, a price level targeter tries to keep the very long run average inflation rate at 2%, but it allows for fluctuations. It allows for times of much higher inflation rates. If that means over the long term, they can be put at 2% or whatever that value they decide to be. Shalom, listen to me. You have destroyed the market, or you've been complicit, continuing on with everything that we've seen before you and with Janet the Felon. And everything that you do simply makes it worse. There is no market without the central bank anymore. Everything is decided by what the central bank does. If they came out tomorrow and said they would be tapering off over the next year and interest rates would be rising over the next year, and they would do so several times over this next year incrementally, the markets would fall. But everybody has this idea that they'll do it so slowly and they will be so cautious that should the market begin to fall, that they would stop and maybe even reverse course. And that's what's happening. So the market knows that it's a fraud, that it's a scam. Simultaneously, they feel that we need to worry about what's really going on. It's a really bad game that they're playing right now. And so that's all for this video. If you found it informative, then please give me a thumbs up. It supports me very much. And last but not least, if you found this video informative, I know you'll find my books, The Money GPS and my new release, Global Economic Collapse, even more informative. If you want to look through these books, you can do so at the links in the description below. Take care. Thumbs up for the Janet Yellen Bernanke hybrid. Take care.